Most traders lose money not because they pick the wrong stocks. They lose because they don't know when to add to a winning position and when to stop. This is the hidden skill that separates the professionals from the broke. The brutal reality is that stock selection itself is almost irrelevant. A trader can identify the best performing asset in the market, but if they don't understand the mechanics of scaling into that position, they will still blow up their account. The amateurs spend 90% of their energy analyzing charts, reading earnings reports, and listening to financial news to find the one. The professionals spend 90% of their energy building a system for when they're right. This distinction sounds subtle, but it is the difference between consistent profitability and chronic losses. Jesse Livermore made fortunes not by being right first. He made them by staying right and compounding small wins into life-changing gains. His documented trading journals reveal something shocking. Livermore's average winning trade wasn't massive. His genius wasn't in picking one $10,000 winner and calling it a year. His genius was in taking a small $500 position, proving the trend was real, and then methodically scaling that position into a $5,000, then $15,000, then $50,000 winner through disciplined pyramiding. But here's the cruel truth. The moment you add to a trade, you're either amplifying genius or accelerating disaster, and most traders can't tell the difference. This is why 90% of traders who attempt a pyramid end up worse off than if they'd simply held their original position. The mechanism is psychological before it's mathematical. A trader enters a position at $100 per share. The stock rises to $105. The trader feels smart. Confidence surges. The amygdala, the fear center, quiets down. And in that moment of false confidence, the trader makes the worst possible decision. They add at $105, believing that if the stock moves to $110, they'll make even more money. But what happens next is predictable. The stock pulls back to $102. Now the trader is underwater on the new position while still holding the original. The emotional pain is greater. The account pressure is higher. And when volatility truly hits, a market-wide sell-off, earnings disappointment, sector rotation, the trader is holding a bloated position at an inflated average cost, and they panic sell at the worst possible moment. 90% of retail traders break their own rules the instant a position moves in their favor. They panic add, they double down emotionally, they pyramid recklessly, and then, when volatility hits, they're margin called or stopped out at the worst possible moment. This is not a character flaw, it is a design flaw in their system. They entered the trade with conviction, but without a protocol for what comes next. They have an entry rule, they have no scaling rule, they have no confirmation rule. And in the absence of rules, emotion fills the void. The amateurs think pyramiding means throw more money at a winner. That's it. That's their entire framework. If it's going up, buy more. This is essentially how teenagers with Robinhood accounts trade. But it's also how experienced, intelligent professionals sometimes trade when they let emotion override discipline. The professionals, meanwhile, think pyramiding means something entirely different. Prove the trend, then scale with surgical precision. Every single ADD is a transaction that requires evidence, not hope, not momentum, not FOMO, evidence, proof, confirmation. Today, I'm revealing the exact one-third formula that Livermore used to compound small $500 trades into $1 million accounts. It's simple, it's brutal, and it works. Because it removes emotion and forces discipline into every single ADD. When you follow this formula, you don't have to think. You don't have to feel. You follow the protocol, and the protocol protects you. This is what separates professional traders from the people gambling in their brokerage accounts at midnight on their phone. The professionals have outsourced decision-making to their system. Here's what we're covering in this deep dive: the 3 layers of the pyramid, how to confirm a trend before you pyramid, why most traders add at the wrong time, and the one number you must never exceed. By the end of this chapter, you'll understand why waiting is sometimes the best trade you'll ever make. You'll also understand the counterintuitive truth that not adding to a trade is often the smartest move a trader can make. The amateurs are adding right now, in real time, to positions that haven't proven themselves. The professionals are watching and waiting, disciplining themselves to add only when the market tells them it's safe. Which one are you? Not in theory, not in intention, but in actual practice. When real money is on the line and emotions are running high, which trader are you becoming? Let's go deeper into how this works. Livermore's pyramid wasn't haphazard. It had 3 distinct layers, each triggered by a different kind of proof. This is critical because most traders think a pyramid is just adding more whenever they feel like it. But that's not a pyramid. That's chaos. That's gambling with extra steps. A true pyramid is a structure. It has load-bearing walls. It has a foundation. Remove one layer, and it collapses. Livermore understood this architecturally. Every layer served a function. Every layer tested something specific. And only when a layer passed its test did the next layer earn the right to exist. Layer 1 is your core position, and it is deliberate. Teely small. This is the position you take when you see a pattern forming but haven't yet confirmed the trend. Livermore would risk maybe 1 to 2% of his trading capital on this trade. Not because he was timid or afraid of losing money. Not because he lacked conviction, but because he hadn't earned the right to be bigger yet. This is the psychological shift that separates professionals from everyone else. A professional trader doesn't equate conviction with size. A professional trader equates proof with size. You can be completely convinced that a stock will rise, but if you haven't yet proven it to the market, you have no business deploying your full firepower. Think of layer 1 as your entry thesis. You're saying to yourself, I believe this stock will move higher based on this pattern, this support level, this volume signature. Let me prove it with a small position. If the stock proves you right, excellent. You've earned the right to add. If the stock proves you wrong, you take the small loss and move on. This is the ultimate form of capital preservation. Here's where amateurs choke, and it's worth sitting with because this mistake is so common it's almost universal among retail traders. They enter with full size immediately. They think, if I'm right, why not go big? Why would I risk small if I believe in this setup? The answer is brutal, and it's worth repeating because it will save your account. You're never as right as you think you are. Not ever. The market is infinitely more complex than any single trader's analysis. Pivotal points that should hold sometimes break. Patterns that have worked 99 times out of 100 suddenly fail on the 100th. Volume signatures that typically precede breakouts occasionally precede breakdowns. The trader who enters small on layer 1 survives to pyramid when all these surprises occur. The trader who enters full size on layer 1 dies. They blow up. They get margin called. They're wiped out before layer 2 even becomes a possibility, and they're forced to tell their spouse why the account is half what it was 3 weeks ago. Layer 2 comes after confirmation, and this is where the definition of confirmation matters enormously. I don't mean the stock moved a little bit in your direction. I don't mean it bounced off support by 3%. I don't mean it's up $1 and you're feeling good. I mean the stock has broken a key resistance level with clear, undeniable evidence, or a pattern has fully formed, and the volume has surged beyond what's typical. At this point, you've now proven your thesis to the market. The market is saying yes, and only then do you add another 1/3 to your position. Livermore called this principle waiting for the tape to tell you. In his era, the tape was the literal ticker tape machine that printed price and volume data in real time. Modern traders have charts and level 2 data and volume profiles, but the principle is identical. He didn't add on hope. He didn't add because he was impatient. He didn't add because he'd read a bullish article on the stock. He added when the data said the trend was real. This data-driven approach to scaling is so foreign to retail traders that it sounds almost passive, but it's the opposite. It's ruthlessly active. You're constantly monitoring the tape, comparing price action to your thesis, and asking, has this stock proven what I thought it would prove, yes or no? Only a yes triggers layer 2. Layer 3 is the trophy add, the final 1/3 that transforms your entire position from interesting into life-changing. You only get here if specific conditions are met. The first 2/3 of your position are profitable. The trend has proven itself at multiple pivot points, not just one breakout BU. A series of confirmed moves, and the risk-reward ratio is still attractive. This is crucial because many traders reach layer 3, and the stock is already up 20 or 30%. They think, well, I've missed most of the move. Why add now? But the professional understands that if the setup was good enough to hold through layer 1 and 2, it might still have room to run. And if the reward potential from here outweighs the defined risk, layer 3 is deployed. This is where your initial 1/3 position transforms into a full-size winner that can potentially double, triple, or quadruple your account on that single trade. But here's the critical caveat that most traders miss. If you never get confirmation at layer 2, you never deploy layer 3. You don't almost see confirmation and add anyway. You sit with layer 1 until the stop loss is hit, or until clear evidence emerges that the trend has failed. This patience is excruciating. You're holding a position that's maybe down 2%. You're questioning yourself. You're wondering if you missed the move. You're tempted to just add anyway and get it over with. But the professionals don't succumb to this. They wait, they observe. And if layer 2 confirmation never arrives, they accept the small loss and move on. The amateurs pyramid all 3 layers on belief alone, on gut feeling, on momentum, on the intoxicating rush of seeing a position move in their favor. The professionals pyramid only on proof, only on market-generated data that confirms their hypothesis. And proof takes time. It takes discipline. It takes willingness to miss some percentage of a move in exchange for certainty that you're scaling into genuine trends, not fake bounces or bear trap rallies. This 3-layer framework also does something subtle but powerful. It psychologically inoculates traders against the twin demons of fear and greed simultaneously. On the fear side, because your initial position is small, you're not terrified if it pulls back. You can think clearly. You can observe the tape objectively. You're not emotionally underwater and desperate to add to bring down your average. On the greed side, because you've defined the conditions for adding, you're not blindly throwing money at every rally. You're controlled. You're systematic. You're building wealth through compound gains, not trying to hit home runs on single trades. Each layer is both a trade and a test of the trader's emotional control and discipline. And that's why Livermore's approach worked across decades in multiple market environments. It wasn't about picking winning stocks. It was about building them systematically, with proof at every stage. Here's the painful irony that cuts to the heart of why most traders fail. The moment a trade starts winning, amateurs feel most confident to add, and that's precisely when they should be most skeptical. This inversion of logic, being most aggressive when you should be most cautious, is so pervasive that it's almost a defining characteristic of retail trading. The psychological mechanism is straightforward. A trader enters a position. The stock moves up, dopamine floods the brain, confidence surges, the amygdala quiets. And in that state of neurochemical euphoria, the trader makes decisions that seem logical in the moment but are actually catastrophic in hindsight. They think, I was right. The stock is confirming my thesis. I should add now while I'm winning. But they're confusing the feeling of being right with the proof of being right. These are not the same thing. Why does this distinction matter so much? Because early momentum is not trend. This is perhaps the single most important sentence in this entire chapter. Early momentum is not trend. A stock bouncing 5% off Upport is not the same as a stock breaking through resistance on heavy volume. They look similar on a chart. They generate similar dopamine hits in the brain. But one is a false move that will reverse within days. The other is the beginning of a structural shift in the stock's trajectory. And amateurs can't tell the difference, so they add to every bounce and get punished when the bounce reverses, as bounces always do. The professionals, meanwhile, have trained themselves to wait for the specific signature of a genuine breakout before they deploy additional capital. Let me give you a story that illustrates this perfectly, because abstract principles don't change behavior. Only stories do. I once watched a trader named Mark, not a professional but genuinely hungry to succeed, buy Apple at $150 after the stock had fallen from $155. He took a small position, maybe 100 shares. This was good discipline so far. This was layer 1. He had a thesis. Apple at $150 had found support, and there was a reversal pattern forming. So he put on the trade. Then, over the course of 2 days, the stock bounced to $151.50, a modest move. Nothing dramatic. But Mark felt smart. The position was working. He felt validated. And in that moment of validation, he made his first mistake. He added. He bought another 100 shares at $151.50, reasoning that if it was going to $160, he might as well have more skin in the game. Then $152. Another bounce. Mark felt even smarter now. 2 winning ads in a row. He felt like he was reading the tape. He felt like a professional. So he added again, this time full size. He bought another 200 shares at $152, convinced that this momentum was the real deal. He was now holding 400 shares at an average cost of $151.38, with a stop loss at $147. His total capital at risk was $1,847 if the stop was hit. But here's what actually happened. And this is where the story turns from validation to devastation. The $152 level was a false bounce. It was a resistance level that looked like it might break, but it didn't have the structural support to do so. There was no volume surge. There was no institutional buying. It was just retail traders and algorithms bouncing the stock off the level, creating the illusion of a breakout. Within 3 days, the stock rolled back down. It sliced through $151, through $150, through $149, and settled at $148. Mark was now underwater on the entire position. The small initial position that was supposed to be a thesis test had become a bloated 400-share position at an average of $151.38, with a stop at $147. When the stock finally hit $147, Mark got stopped out for a $1,752 loss. A trade that should have been a $200 thesis test loss turned into a $1,752 catastrophe because Mark couldn't distinguish between a bounce and a breakout. Now, sitting next to Mark during this entire sequence was a professional trader. Let's call her Sarah. She had done something remarkable. She had entered the exact same Apple trade at the exact same $150 level with the exact same position size as Mark's layer 1. She also watched the bounce to $151.50. And then she did something that looked passive, but was actually aggressive discipline. She waited. She said to herself, show me you can hold $152 and take out $153 on above-average volume. Then I'll believe this is a real breakout, not a dead cat bounce. Then I'll add. Until then, I'm watching. The stock bounced to $152, just like it did for Mark. And Sarah watched it fail to hold. She watched the selling pressure return. She watched the volume dry up. And when it became clear that the breakout wasn't happening, she exited her layer 1 position at a small loss, maybe $50 per share, $100 total loss on 100 shares, a clean XI. A thesis that didn't work out, and then she moved on to the next opportunity. But here's where the story gets interesting. That same week, a different stock came into focus, Tesla. Sarah entered at $220 after observing a support hold and early reversal pattern. Layer 1, small position, $220 entry. Then the stock bounced to $223. Sarah watched. And then something different happened. The stock broke through the $225 resistance level, not on modest volume, but on 50% above average volume. This wasn't a bounce. This was an institutional breakout. Only then did Sarah add the second third of her position at $226. She scaled into genuine confirmation, not into early momentum. That Tesla trade went on to run 50%. Sarah made $15,000 on it because she had the discipline to add only after the tape told her the trend was real. The rule that separates professionals from everyone else is deceptively simple. Add only after a clear breakout of resistance, confirmed by volume, that is held for at least 2 to 3 days. Not bounces, not hopes, not feels right energy or gut intuition or FOMO or any of the emotional drivers that plague retail trading. A measurable break on measurable volume that has demonstrated staying power. This rule eliminates the single biggest killer of retail accounts, the addiction to early rightness. Amateurs are addicted to the feeling of being right immediately. They want validation now. They want proof now. So they add to every signal that feels right, which is almost never the right time to add. Professionals have trained themselves to wait for measurable, market-generated proof. They can sit through the first bounce, knowing it's not the move. They can watch the stock move to $151.50 with complete emotional detachment because their system hasn't given them the signal to add yet. And when the signal finally comes, the breakout on. Volume held for multiple days. They add with conviction because the market itself has validated the move. Amateurs add to hope. Professionals add to proof, and proof requires patience, the one thing amateurs never have. This is why Livermore's tape reading was so powerful. He wasn't trying to predict the future. He was waiting for the market to announce what was already happening. He was patient. He was skeptical of early momentum, and he was ruthlessly mechanical about the conditions that had to be met before he added to a position. This approach solves the amateur's core problem. They add when they feel best, early bounce, high confidence, dopamine rush, rather than when the data is strongest, breakout confirmed, volume confirmed, multiple day hold confirmed. The emotional payoff is inverted from what most traders expect. Patience and skepticism produce larger gains than premature scaling and aggressive adding. This is the confirmation rule, and it's worth tattooing on your brain. Here's the secret nobody teaches, and it's worth more than most trading courses you'll ever buy. The 1/3 pyramid only works if every single layer has its own unified stop loss. Not 3 different stops, not moving stops, not I'll decide when it gets there stops. One stop, one price, one level where you exit all 3 layers simultaneously if the thesis breaks. This is the structural integrity of the pyramid. Without it, you don't have a pyramid. You have a house of cards waiting for the wind. The psychological difference between amateurs and professionals on this point is stark. Amateurs think, I'll just hold and see what happens. I don't want to lock in a loss by setting a stop. If I just wait long enough, it'll come back. This is hope masquerading, a strategy. Professionals think something entirely different. I'll hold until this specific price. If we hit that price, the thesis is broken, and I exit all 3 layers immediately, period. No discussion, no emotional negotiation. The price level decides for me. This mindset shift is radical because it removes the decision-making burden from the moment when you're most emotional. You're not deciding whether to exit when you're underwater and scared. You've already decided. The price level has already decided for you. All you have to do is execute the predetermined plan. The moment you add to a position through pyramiding, you need to understand something fundamental. You're not 1 trade anymore. You're 3 trades. You have 3 separate entry points. You have 3 separate conviction levels. You have 3 separate amounts of capital at risk. And yet they all share one thesis. The stock will break above key resistance on volume and trend higher. If that thesis breaks, if the stock falls below the support level that triggered your original entry, then all 3 trades are wrong. Not just one, all of them. And each one must have a defined exit, and that exit is the same for all 3 layers. Let me explain why this matters with real numbers. Because numbers are what separate theory from actual practice. Let's say you enter layer 1 at $100 per share, 100 shares, risking 1% of your trading capital or $1,000. You put your stop at $95, a clean 5% logical stop below that support level that triggered your entry. If the stop is hit, you lose $500 on that layer. Small, manageable. The thesis test fails, and you move on. Now layer 2, the stock breaks $105 resistance on volume. You add another 100 shares at $106. Your stop for this layer? Also the same level, $95. This is critical. Why 95 and not, say, $103? Becca, if 95 breaks, your original thesis has failed. It doesn't matter that you added higher at 106. It doesn't matter that this layer is only underwater if the stock hits 95. If 95% breaks, it means the support level that justified your entire thesis is no longer valid. The thesis is dead. And when a thesis is dead, all layers of the pyramid built on that thesis must exit. Now you are holding 200 shares total with $2,000 at risk if 95 breaks. You can absorb it. It's manageable risk. It's not pretty, but it's survivable. Layer 3, the stock runs to 110, breaks 112 resistance hard on explosive volume. You add 100 shares at 113. Same stop, $95. You're now holding 300 shares, a $33,900 position. If the stop at 95 is hit, you lose $5,400 across all 3 layers. Here's the kicker that most traders miss. That 16% drawdown from your highest entry to the stop loss is manageable because your 3 positions were scaled properly from the beginning. You entered small on the thesis test. You added only at confirmation. You risked defined amounts at each layer. You never got carried away. So even though you're holding 300 shares, the maximum loss is known and acceptable. But here's what kills amateurs, and this is where the story gets dark. They add without stops. They rationalize it. I don't want to lock in a loss. I'm long-term on this stock. Stop losses are for wimps. Or they add without stops and then, when the stock pulls back, they move the stops lower to avoid getting stopped out. Both of these approaches are emotional responses. Both are fatal. Let me tell you about Dave, a trader I knew who made this exact mistake. Dave bought NVIDIA at $200 after a breakout. Good start. Then it pulled back to 195, consolidated, and broke higher again. Dave added at 210. No stop loss. He added again at 220. Still no stop. He added a fourth time at 230. By now he was holding 400 shares at an average of 215, with nearly $90,000 at risk and zero defined exit. Dave's rationale was simple. Long term, this goes to 400. I'm not going to give up shares on a pullback. Then NVIDIA pulled back to 190. Dave was underwater on the entire position. Instead of triggering his stop, which he didn't have, he did something worse. He added again, averaging down. He bought more NVIDIA at 190, convinced that this was a gift, a chance to average down into a stock he believed in. Now he was holding 500 shares at an average of 210 with nearly $105,000 at risk. He was bigger and broke. He was trapped. He couldn't hold through any further pullback without risking liquidation. When the stock bounced to 195, Dave panicked and sold the entire position for a small profit. Convinced he dodged a bullet, he made maybe $1,500 on a massive position that should have made him $20,000 to $30,000 if he'd simply had discipline. He never saw 400. He was too leveraged, too underwater, and too emotionally fragile to hold through normal market pullbacks. The lack of a stop-loss didn't protect him. It destroyed him. The professional pyramid lives by a single rule that's worth writing down and taping to your monitor. Each layer has the same stop. The stop is set at the break point of your original thesis. If that level breaks, all three layers exit simultaneously, period. No negotiation, no moving the stop, no let me wait and see. The price level has spoken. The thesis is broken. You're out. This isn't pessimism. This isn't fear-based trading. This is survival. And survival is the only real superpower in trading. You can't compound wealth if you blow up your account. You can't pyramid into winners if you're trapped in bloated positions with no defined exit. You can't scale winning trades if you're terrified of pullbacks because you have no stop loss to protect you. The unified stop loss also does something subtle to your psychology. It gives you permission to add. Because you've defined the maximum risk up front, you can add without fear. You know exactly what you stand to lose. It's defined. It's knowable. It's acceptable. So when Layer 2 confirmation comes, you add without hesitation. When Layer 3 confirmation comes, you add without hesitation. You're not adding blindly. You're adding into a defined risk structure. The stop loss isn't a sign of weakness. It's the foundation that makes aggressive pyramiding possible. This is the paradox. The pyramid is safer and less risky because every layer is small and stacked with defined exits, not riskier. Most traders think more layers equals more risk, but a properly structured pyramid with a unified stop loss is actually lower risk than holding a single oversized position without a stop. Remember this when you're tempted to add without defining your exit. This is the chapter that separates traders from speculators, not entry skill, not technical analysis ability, not market timing, patience, the willingness to do nothing while everyone else is doing something. Livermore made millions sitting still, not trading, not adding, not obsessing over charts, waiting. And amateurs never understand this because waiting feels like losing. It feels like missing out. It feels like laziness. It generates no dopamine hits. It produces no stories to tell at dinner. It doesn't feel like winning, but it is the single most profitable activity a trader can engage in. And yet it's the one activity that 99% of traders refuse to do. Here's the brutal truth that will save your account if you absorb it. Most traders lose money not on bad trades, but on unnecessary trades. This distinction is critical. A bad trade is one where you enter with a solid thesis, but the market proves you wrong. That's acceptable. That's the cost of trading. But an unnecessary trade is one you never should have entered in the first place. You didn't have confirmation. You didn't have a clear setup. You just had impatience and the inability to sit in cash. These are the trades that kill accounts, not because the losses are massive, but because they accumulate. You layer into a position, don't get confirmation at layer 2, but you can't accept it. So you add anyway, violating your own rules, or you hold layer 1 longer than you should, hoping confirmation will eventually arrive. Or you just try one more position while waiting, turning your account into a carousel of churning trades with no conviction behind any of them. The professional trader, meanwhile, does something that looks almost insane to the amateur. They close layer 1 if confirmation doesn't come in the expected time frame, and they sit in cash waiting for the next setup. They walk away from a position that's slightly profitable or slightly unprofitable, and they sit in cash. No positions, no stimulation, no action, just waiting. This is where professionals are forged, and this is where amateurs break. Let me walk you through a specific example that illustrates this perfectly, because this principle is so counterintuitive that only a real story can make it stick. I watched this play out wit. A trader named Rachel. She's a professional caliber trader, the kind of person who treats trading like an actual business rather than a gambling hobby. She entered Shopify at $600 after observing a clean support break. Layer 1, 100 shares, stop at 580. She was patient. She had a thesis, and she was willing to test it with small capital. 2 weeks passed. No breakout to 610. No volume surge that would trigger layer 2. The stock just drifted sideways, bouncing between 602 and 608. It was doing nothing. It was a non-setup. Rachel had entered with the conviction that Shopify would break above 610 on volume within 10 trading days, or she was wrong about the setup. That was her thesis. That was her confirmation window. Day 8 arrived. Most traders in Rachel's position would have done something. They would have added, hoping to catch the move that was surely coming. They would have moved their stop higher, hoping to avoid being stopped out. They would have bought some covered calls to generate income while waiting. They would have done something to justify staying in the position. Rachel did something radically different. She closed the position at 603 for a tiny $300 loss. I asked her why. I said, "Rachel, the stock is near your entry. You could have just held. It might break out tomorrow." She looked at me like I'd suggested she set her money on fire. "Because the setup didn't confirm," she said calmly. "And I don't add to uncertain setups. I don't hold uncertain setups hoping they'll work out. I wait for the next one. The setup failed the test. I'm out." That was it. No drama. No regret. No FOMO about what might happen. Just clean execution of her protocol. The setup didn't confirm in the defined time frame, so she exit and moved on. 3 weeks later, a different stock came into focus, Apple. Rachel saw something she recognized immediately. A double bottom formation. A volume spike on the break above the second bottom. It was the setup. Layer 1 entry at $195. This time the confirmation came fast. The stock broke $200 on heavy volume within 3 days. Layer 2 triggered. Rachel added at 202. The trade worked. Rachel made $8,000 on that Apple position through the combination of Layer 1, Layer 2, and then strategic profit-taking as it ran higher. And here's the kicker that makes this chapter worth reading. If Rachel had held Shopify and added anyway, she'd have been sitting in a $1,200 loss when that perfect Apple setup materialized. She would have been underwater and emotionally compromised. She wouldn't have had the capital freed up. She wouldn't have had the emotional clarity. She wouldn't have been able to execute the Apple trade with full conviction because part of her brain would have been obsessing over the Shopify loss. By refusing to add to the uncertain Shopify setup, by accepting the small loss and sitting in cash, Rachel had preserved something more valuable than money. She'd preserved her capital, her emotional bandwidth, and her ability to execute the next great setup without regret or distraction. The Livermore rule that emerges from this pattern is worth tattooing on your brain. Waiting for confirmation is not laziness. It is not weakness. It is not missing out. Waiting for confirmation is capital preservation in its purest form. The cash you don't spend is itself a position. It is a position in optionality, the right to enter the next great setup without regret, without being trapped in a losing position, without being psychologically compromised by past mistakes. About this reframe, Most traders view cash as dead money. They think cash is the absence of a position. But professionals view cash as the most important position they hold during certain market phases. Cash is liquidity. Cash is flexibility. Cash is the ability to scale into the next winner when it arrives. Cash is freedom. Most traders move into 5 to 10 positions per month because they literally cannot stand being in cash. They get fidgety. They get anxious. They get FOMO. They start pattern matching, setups that aren't really setups, just so they have something to do. The professionals, meanwhile, might enter 3 to 4 positions per month, pyramid fully into 1 or 2 of those positions, and sit in cash the rest of the time. 60 to 70% cash sometimes, just waiting. Is it boring? Absolutely. Is it profitable? Radically, exponentially profitable. Because when the professional finally does enter a trade, they're not just randomly entering. They've been waiting for the setup that meets their specific criteria. They're entering with conviction. They're entering when confirmation is present. They're entering ready to pyramid. And they're entering without the psychological baggage of 5 failed trades that they forced into the market out of impatience. Livermore's greatest documented trait was not his ability to enter trades. Plenty of traders can do that. His genius was his willingness to wait for perfect setups and his discipline to abandon setups that failed to confirm. This patience manifested as holding capital in cash when no high-probability setup existed. That cash generated no excitement. It produced no stories. It felt like losing to most traders. But it was actually the superpower that let Livermore compound wealth exponentially. While most traders churn their accounts into losses, the psychological shift required here is profound. Tours view waiting as failure, as missing out, as a sign that they're not good traders. If I were really skilled, they think, I'd be making money every month. Professionals view waiting as capital preservation and the prerequisite for conviction. If I'm only entering high-probability setups with confirmation, the professional thinks, I might only trade 3 times a month. But each of those trades will be executed with full conviction and proper pyramiding, and that's where my wealth comes from. This single rule, the discipline to wait, to sit in cash, to refuse unnecessary trades, explains why Livermore's accounts compounded exponentially while most traders churned their accounts into losses through chronic overtrading. The cash position is not dead money. It is the foundation of future profits.
Let me walk you through the entire 1/3 pyramid protocol start to finish so you have no excuses for execution.
This is not theory. This is not aspirational. This is the exact mechanical framework that Livermore documented in his private trading journals and letters. Every step is defined. Every trigger is spelled out. Every decision point is predetermined. Your job is to follow it, not to improve it, not to customize it with your own intuition, but to execute it with mechanical precision until you've proven to yourself that it works. Only then can you refine it. But first, you must follow it exactly as written. This is where observation begins. You're scanning the market for stocks at pivotal support levels showing pattern completion. This could be a double bottom formation, where a stock has touched a support level twice and is preparing to break higher. It could be a base building pattern where a stock has consolidated for weeks or months and is coiling for a breakout. It could be a reverse head and shoulders pattern or any other technical setup that suggests reversal is imminent. But critically, this is not your entry yet. You're in the observation phase. You're watching the tape. You're seeing if the stock can actually hold the support level and show volume on the bounce. Most traders skip this phase entirely. They see a pattern and immediately enter. Professionals watch the tape, confirm the pattern before deploying capital. This observation phase might last 3 to 5 trading days. You're not in a hurry. You have all the time in the world. If the setup doesn't work out, there will be another one next week. The stock breaks above the support level on the upside, or it holds support and shows a volume surge that signals institutional buying. This is your signal to enter. You deploy 1/3 of your intended final position size. Your risk is 1 to 2% of your total trading capital. Your stop loss is set 3 to 5% below your entry at the breakpoint of the support level that originally triggered your interest. This is critical because if that support level breaks, your thesis is dead, the pattern failed, the reversal didn't work. You exit. Here's a concrete example. A stock is trading at $100 per share after holding support at $95 for 2 weeks. Volume has been light. You're watching. Then one day, on above average volume, the stock breaks above $100. This is layer 1 entry signal. You buy 100 shares at $100, risking $1,000 or 1 to 2% of your account. Your stop loss is at $95. If the stock falls back to 95, you exit the entire position for a $500 loss. Clean, simple. Defined. Hold your 100 shares. You wait. The stock must now prove itself. You don't get moved by news stories. You don't get spooked by one-day pullbacks. You don't get excited by one-day rally. Yes, you're looking for one thing and one thing only, a measured rally that sets up the next resistance level. You're looking for the stock to consolidate around 100 to 105, and then show signs of breaking higher to 110 or beyond. Duration, 3 to 10 trading days is typical. This is the window where Layer 2 confirmation should emerge. If no setup for Layer 2 forms, if the stock just drifts sideways or pulls back to test support, you exit at break-even or a small loss and move to cash. You don't hold hoping. You don't add to average down. You exit and wait for the next setup. This discipline separates professionals from everyone else. The stock is held above 100, consolidated around 105, and now breaks the next resistance level, let's say 108, on above-average volume. Volume surge is non-negotiable. You can't add to a breakout on weak volume. That's a fake breakout waiting to fail. But on above-average volume, 150% of the 30-day average or higher, you add your second one-third. You buy another 100 shares at $109, just above the breakout level. Your stop loss remains at $95. Same stop as Layer 1. Why? Because if 95 breaks, both your Layer 1 thesis and your Layer 2 thesis have failed. You're not differentiating between the layers. You're asking one question: did the original support level hold? If not, all layers exit. Now you're holding 200 shares at an average cost of $104.50. Your total capital deployed is $20,450. Your maximum risk at the $95 stop is $950. Still manageable, still sustainable. You let this run. The stock is working, but you still don't add. You wait.
Sit.
If your 200 shares, the stock rallies from 109 to 113. You feel great. You want to add. You don't. You wait. You're looking for the next resistance level to come into play. Usually this is a major level like a 52-week high, or a multi-year resistance level, or a gap that the stock needs to fill. You're watching the tape. You're measuring the strength of the rally. You're asking, is this stock strong enough to break the next level, or will it fade? The stock breaks the next major resistance, let's say $115, on explosive volume, 200% above average or higher. This isn't a normal breakout. This is an institutional breakout. This is the signal that says the trend is real and potentially has real room to run. This is the trophy ad. You deploy your final one-third. You buy 100 shares at $116. Your stop loss remains at $95. You're now holding 300 shares at an average price of roughly $107 per share. Total capital deployed is $32,100. Your maximum loss at the $95 stop is $3,600, which is about 11% of your position size or 3.6% of a typical $100,000 account. That's sustainable, that's manageable, that's the whole point of the pyramid structure. You're sitting with 300 shares, average entry around 107, stop loss at 95. The maximum downside is defined and knowable. The upside potential, if this runs to 130 or 140, is $6,900 or more. That's a 3-to-1 or better reward-to-risk ratio. This is the asymmetry that creates wealth. You're risking a defined amount to capture exponential upside, E. Once the position is 15% or more profitable, you can implement a trailing stop that locks in gains. Or you can take profits in thirds, sell the first third at a 20% gain, the second third at a 40% gain, and let the final third run with a trailing stop, capturing the bulk of a major move. Or you can hold the entire position using the original $95 stop and reevaluate at each breakout, taking partial profits at major resistance levels. The specific exit method matters less than having a defined protocol before you enter. Enter small on your Layer 1 thesis test, 1/3 size, 1 to 2% of account risk. Confirm before adding. Wait for resistance breakout on above average volume before deploying Layer 2. Add only at clear breakpoints where the market is showing strength. Use one unified stop loss at the original support breakpoint. Wait 3 to 10 trading days between layers, allowing the market to confirm each move. If Layer 2 confirmation never arrives, exit and move to cash. If Layer 3 never arrives, hold your Layer 2 position using the original stop and let it run or exit strategically. This system lets you compound profits on big moves because your Layer 3 deployment captures the final 5 to 10% of a major breakout, the percentage where most of the money is made. Simultaneously, it caps losses because the unified stop loss is always set at a logical level where your original thesis breaks. Amateurs risk big on thesis tests, deploying full size on Layer 1, which means they blow up if the thesis fails. Professionals risk small on thesis tests and add only to proven moves, which means they compound wealth on the moves that actually work. This is the exact protocol Livermore documented in his private letters and trading journals. The specific percentages, the volume requirements, the timing windows, all of this was his actual method. He didn't invent something radically different from what's written here. He refined and tested these principles across decades of trading, through booms and crashes and everything in between. The protocol survived every market environment because it's built on human psychology and market structure, not on indicators or indicators that expire. Your job is to apply it, not to perfect it, not to wait for the perfect setup, not to tweak it endlessly in a simulator, but to trade it live, log every single execution, and refine your confirmation filters over time based on actual results. Keep a journal. Write down every Layer 1 entry, every confirmation wait, every Layer 2 trigger, every exit. Over 3 to 6 months of live trading, you'll see which confirmation filters work best for your personality and market conditions. That's when you refine. But first, you execute exactly as written. The amateurs are still hoping. They're still adding on bounces. They're still holding without stops. They're still churning through unnecessary trades. The professionals are now following this protocol. They're entering small, waiting for confirmation, adding to proven moves, and compounding wealth systematically. Which trader are you becoming? Not in theory, not in intention, but in actual execution starting tomorrow morning when the market opens. Which trader will you be?